morning, everyone. My name is Jenni Brown, and I am the founding partner of Brown Dutton Law Firm. And with me today is, of course, Lance Dutton,
Hey.
our other founding partner. Today, we are again discussing our second part of our of an old webinar. This one today is focusing on business valuations and how Georgia determines the value of a business, which comes into play in divorces. It comes into play if you're selling your business, but we see it a lot in litigation. And so we're really happy today that we again are getting to talk to two specialists in the area that end up helping us a lot when we come across clients who have businesses and we need to figure out what the value is. So Luke and Marty, if y'all could each take a second and introduce yourselves, that would be great.
All right. Good morning. My name is Luke Thomas. As my bio says there, I've joined IAG in 2011, so I've been there a little over 9 years now. I've worked on a variety of forensic accounting cases at IAG, but for the last 6 or 7 years, focused primarily on family law. And as part of that is doing business valuation work for both divorce cases and for other purposes.
I'm Marty Varon. I'm a partner at IAG Forensics, and I practice mostly business valuations. I'm a CVA, which is Certified in Valuation Analyst, and ABV, accredited in business valuations through the AICPA, and I teach the valuations of closely held businesses at Kennesaw State University at night.
So Luke and Marty, today we're going to talk about just in general how Georgia determines what the value of a business is. I think too often we have clients come in and, you know, unfortunately one party thinks the business is worth one amount and the other party has a very different understanding of what a business is worth. And so I really want to take some time today to explain and have people understand how Georgia determines that, and how is the judge or how is the trier of fact going to really put a value on a business. And so can you just generally, we'll dive into each approach, but just tell us what does Georgia use to determine and figure out what a value of a company is?
Sure. So Georgia law prescribes that we have to use three approaches. We have to consider, three approaches when we're doing a business valuation. Now that doesn't mean that all three approaches are going to be relevant to the value of the subject business, the business that we're trying to come up with a value for. But we have to look and consider all three approaches to decide if that approach bears any weight in the consideration or not. You know, so it doesn't mean that we average the three to come up with the value. It doesn't mean that, oh, we know off the top that this is going to be a case where we're going to look at the income approach and we don't look at the other two, or we look at two of the three. We have to consider all three in every case and then come up with rationale as to what the weight is or why we didn't use that approach or consider that approach in coming up with the value.
And working with attorneys like yourself, you tell us that there's an actual case law in Georgia to follow that prescribes the three approaches that Luke was referring to. And that case law follows American Institute of Certified Public Accountant Standards. And also there's a revenue ruling from the Internal Revenue Service that says the same thing, the three approaches.
And a question I think that we come across is, and Luke, you sort of mentioned this, is that, you know, there's three approaches and, you know, you don't necessarily use all three or just one, but is there hard, fast rules of, okay, well, this type of company, you always use this approach, or this type of company, you always use this approach, or not necessarily?
You know, much like everything in litigation, there's no hard and fast rules. You know, an ongoing operating business, frequently you're going to look at the income approach, but it depends on how the business is doing. In some cases, the asset approach may be, you know, if the company's looking to liquidate, they're not doing so well, especially during COVID, as we've sort of seen recently. You know, so there are sort of general guidelines as to what approaches are probably most appropriate for the industry. You know, an asset approach may be appropriate for a real estate firm or construction or a manufacturing firm, but again, it really depends on a case-by-case basis.
Okay, well, let's dive right in. You want to talk about the asset approach first?
Sure. And I'll tell you one other thing I'll mention when we look at the three approaches, and this will come up later, the standard of value that we're looking at is that a hypothetical seller and a hypothetical buyer, and both a willing seller and a willing buyer. So frequently we realize that in a divorce case, the business owner is not wanting to sell their business right now. We're not asking them to sell their business. We're saying, if you sold your business, what sort of value do you think do we think you would receive? And that assumes that, again, the seller would be willing to sell it and trying to sell it for as much as possible. And a buyer, of course, be a willing buyer, would want to purchase it for as low as possible. And of course, the market is where it comes out, with the appropriate value. So.
And this fair market value standard is applicable for a Georgia divorce. And the value could be different if they were looking at an investment standard or value, where a company could be coming in to acquire the subject company, but there would be synergies and savings. And so they might be willing to pay more. Sort of like when Pepsi Cola bought Taco Bell, they were willing to pay more than a fair market value because they knew they would start. Both companies had accounting departments. They don't need two accounting departments. So there's going to be cost savings. But that's different from family law is fair market value, as Luke just mentioned.
Good point.
Yeah, definitely.
All right. So the easiest approach to sort of describe first is this asset approach. It's frequently called book value approach or market value. And really, this approach is considered when the operating value is not the largest value for a company. So frequently a dental practice or another business that when you're purchasing that business, you're really buying it for the ongoing revenue that's coming out. But in some cases, if businesses are suffering, if they're not producing the revenues and profits that they used to, the book value or asset approach is what we would use. And that's simply the market value of the assets less any liabilities that the company has, and that's the leftover cash essentially that the business would be worth. And so question one is, when is this used? Now it's not always just used for liquidation value, but so as I mentioned earlier, manufacturing firms, real estate firms that have hard assets that are of value. Much like a law firm, that's not going to you're not going to typically use the asset approach. People wouldn't purchase a law firm for the desks and the computers and the big law books that you guys have, or the electronic law books now. That's not really what they're purchasing. But again, if a business is in distress, we could look at the asset approach, because that's really the bare minimum that the business is worth. We use that we call it the floor, right? Even if somebody wants to come in and say, well, my business isn't generating as much revenue as it used to, blah, 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 it's worth zero. Well, typically businesses aren't worth zero, maybe close to zero or not a lot of money. But again, you would use the asset approach to set the floor. If you sold off all your assets, paid off all your debts, that's what you'd be left with. That's the minimum value of the entity. And benefits of this approach are that, like I said, it's typically easier to calculate because you're looking at the market value of the assets. There's less, subjectivity to in some cases to doing that when we're looking at liquidation value. Flowing into that, when you talk about challenges with the asset approach, we as business valuation experts don't value the hard assets of the business. We start with the book value that comes out of the tax returns and out of the financial statements, but frequently that's not what the market value is of an asset. For instance, I mentioned a real estate firm or a construction firm that would have bulldozers or something. We don't know what the value of a bulldozer is in the market today. We know what the value is according to the books, but that bulldozer has been depreciated over time, and it may be worth more than what the depreciated value is indicated by the accounting records. So for instance, I always talk about, like a 1965 Mustang. Well, it's certainly been depreciated to zero, but a 1965 Mustang is not worth zero. It's got a market value. So that would be a challenge with the asset approach. If it is the main indicator of value, you're going to have someone value the assets of the company that we can't do. We can do it from a book value perspective, but that's probably not the most accurate.
So how would you handle a situation if, let's say, a client comes in and they own a business, and the business is they own and operate 3 trailer parks, right? And so the value of those locations are pretty high, but they're also generating an income from the lots and from the rent. How is that handled when there are valuable assets, but there's also income?
Right. So one small piece of that is the real estate that's associated with the business. We would move that off the books and tell you you would need to get somebody to appraise the real estate separately. That's a separate asset. If somebody bought this trailer park business, they wouldn't necessarily buy the land. They could buy, the owner could retain the land, and the new buyer could buy the trailer parks, and the clients that are essentially renting out from there. So that would be one small thing. When you talk about that there's value to the actual trailers, and then there's value to the revenue that's coming in from rents, less the expenses that have to go out. You're really talking about the 2 different approaches. And again, we won't add them together. We will weight them appropriately. So if we valued the trailers or had indicators of value as to what each of those trailers are worth, that creates the asset approach. And then the income approach is what you were talking about in terms of the rents coming in less your expenses. So we don't add those together, but we average them or weigh them together to come up with a combined value.
Similar to, in response to your question, we had a funeral home a few years ago that we had to put a value on. And the opposing expert had done a good income approach, said, look, they're not generating a lot of profits. There's not a lot of value here. And we agreed with what he analyzed on his income approach. However, what he forgot to look at was the asset approach, because when we had an appraisal done on the real estate and the land and the building, and net of mortgage, that was worth $3 million. And as Luke said, that typically becomes the floor. You can't go below the 3 million. So we said, you could shut this place down, put the building and the land up for sale, and you're going to net $3 million. So it's worth at least $3 million.
Right. But I think sometimes as the business owner, they would, they see the businesses at that moment worth 0, when in fact, that's probably, not the case.
Right.
All right. So let's talk about market approach.
So market approach, I frequently talk about it being very similar to FMLS for homes, for sales and purchases. A lot of folks out there own a home or sold homes, and they realize, FMLS, days past, you had your real estate broker or realtor use this database to look for comps. And, especially in Metro Atlanta, there's a lot of comparable sales for a home if you're getting ready to list your house. So the same thing with the business, with a business valuation. We subscribe to databases. And we have about 3 that we subscribe to, and that's pretty standard. There's 4, 5, 6, 7 are out there in total. And these business databases are populated by transactions that purchases and sales of businesses that are reported from business brokers. There are various brokers out there that help folks sell or purchase businesses, and they get a commission for reporting, or a fee for reporting the data from those transactions to these databases. So that's really and then we compare how these other transactions have sold to our subject company, usually percentage of revenue or percentage of EBITDA, percentage of gross profit, something like that. So for instance, if we see that you've got 10 transactions out in the marketplace in the last 6 months in Georgia that's very similar to our business, let's take a dental practice, for instance, we see that 10 different dental practices have sold, and they're about the same size, and they've been in the last few months. We would say, okay, well, those dental practices sold for about 30% of sales. So our subject company, at least the initial indicator would be that our subject company is worth 30% of its sales. So if it had sales of $1 million, we'd say, according to the market approach, the value indicated is $300,000. And again, so question number 1, when is this used? We use this very frequently. We use this in conjunction with the income approach frequently, because you're relying on the operating income or the revenue or EBITDA, gross profit. So this is a very frequent use for business valuations. Benefits of this approach, you know, especially for going back to dental practices again, which are bought and sold frequently. The benefits are if we have a lot of transactions in the databases, that gives us a lot of confidence when we do our data analysis to figure out, you know, if we've got 1,000 transactions for dental practices over the last 3 years, we've got a pretty good idea of what dental practices sell for and what the value of our dental practice is that we're valuing. Now, on the other side of that, the challenge for the market approach is if we don't have a lot of transactions for the subject company that we're looking at. You know, there are a lot of niche businesses, especially this day in this economy. It's very complex. And it's, even if you find some subject, you know, some similar companies, it's often hard to tell from the data that we have if they operate very similarly to our subject company. You know, general contractors or different kinds of contractors, that kind of thing. That's a big challenge with the market approach. And also I mentioned this data is reported by business brokers, and sometimes there's a limit to how much information we get from each database. Some databases have a little bit more information than others. And then frequently we will see mistakes or outliers in the data. And we have to make sure we do a good job of you know, cutting those out and not putting weight on those and making sure that they influence our analysis.
And to just highlight a couple of great points Luke made. So first we look at, make sure you're in the same industry, because if you're doing an evaluation of a dental practice, you don't want to look up what a restaurant sold for. Similar size, typically by sales and assets. So if our subject company had $1 million in sales, we don't want to look at a sale of a company, a dental practice that had 10 million in sales. Then we're going to look at the time. You want to look at the last few years. You don't want to go back to 08, 09 when it was a recession. And geography. So typically we would kick out Canadian sales. And one of the challenges with the market approach is that it's an optional system. So let's say we have the perfect sale of a similar company, similar size, that sold last month in the similar, very close geographical area. However, if the buyer and seller said, you know, this is our personal business, we're not going to share it with your database, that would be a dynamite item to reflect what the value is, but we may never know about it because they elected not to share it with our database. So we don't know what's missing out of the database.
That was going to be my question, is that, you know, difficulty that I've seen with this approach is that you might even know of a business that sold, but you're at the mercy of that seller and that purchaser of releasing the information, and they may not want to give you that information.
Exactly.
Correct.
You're not involved in the case. They have no obligation, you know, to show you what they purchased the company for if they're not willing.
Right. There are some alternatives to the databases that we can look at that sort of go along with the market approach. There are rule of thumb books that are put out by business brokers that sort of talk about, you know, generalized statistics for certain industries. We've found others, you can find other sales through other internet resources these days, but the databases are the best source for these transactions. But like you said, you know, FMLS, almost every home sells or is recorded through FMLS, but certainly for businesses, that's not the case. Nobody knows what the percentage is, but it's certainly much, much, much lower than FMLS in terms of home sales. You know, there are tens of thousands of transactions for businesses a year. And we're not seeing that, or thousands and thousands of transactions a year. And we don't always have that for each industry that we look at.
How do you factor in changes that, I mean, whether it's area, so say it's a sale of a business in rural Georgia, right, versus Buckhead. It's the same type of business. It's, you know, comparable sales, but the area is very different. How do you factor that into the market approach?
Well, one thing we're going to do is we're going to do some comparative analysis. We're going to look at all the tax returns for the last 5 years and internal financial statements and look at their statistics of how they've interacted. You know, what's their cost of goods sold as a percentage of their sales? What are their various administrative expenses as a percentage of their sales? And we're going to compare that to the comparables that we find in the market approach and see if, again, if they're similar. If they're not similar, we've got to ask ourselves questions. Are these good comparables? Why is it the subject company's a little bit different? You know, there could be a good reason for it, and it's something we can adjust for. So if you have businesses of similar revenue in Buckhead versus, you know, somewhere quite a bit further out, outside of Metro Atlanta, again, we're just going to compare their operating statistics and see if those, you know, if the cost of goods sold percentage is how that relates.
And is that the same with uncontrollable factors? Like, for example, this year, right? No one expected COVID and all of the repercussions that have came with that. So a business that might be selling this year might look very different than a business that is selling 2 years ago. How do you factor that in?
Well, so that's a great point. And that kind of flows into the income approach that we'll talk about next. It certainly works with the market approach too. We typically like to look at 5 years worth of financial data. That doesn't mean that we're averaging the last 5 years to come up with, okay, what's this company's typical operating year? You know, the best indicator of the future is typically the past. We can also do a look at projections. Excuse me. If companies do have projections of where they think their revenues and expenses are going to go, typically with closely held businesses, they don't do projections. They're costly, they're time consuming, and you know, they don't necessarily provide the information that smaller closely held businesses use. But COVID is a great point that we do have to consider the current environment for the business, because the standard of value that we mentioned earlier, fair market value, is fair market value of the business today, not fair market value of the business 6 months ago or last year or 2 years ago, or even fair market value of the business in a year. We have to consider is what is it today? And restaurants and a lot of businesses, especially when COVID was, you know, new to everybody and we had a lot of shutdowns, that heavily affected businesses, and it made it a real challenge to consider what was the value of the business today. What would somebody pay for my business if I sold it today? And the market approach is going to be limited by the transactions that are reported, and it takes a few months for those to get in. So we're just now starting to get a few transactions in each industry, right, for the market approach. It'll take some time for it to really show up as to what the impact of COVID was.
So, Luke, I have a follow-up question on that one then. And maybe so people are listening, y'all get involved if there's a divorce and husband or wife owns a business and there's obviously a disagreement on what that value is, then people like you will come in to hopefully ascertain and provide a value not only to the parties, but also eventually the court. But let's say that you, and the restaurant business for COVID is a great example, you do your analysis and fair market value, have that component of it. And as I said, you value it as of today. If it was going to go in the market today and be sold, this is what it would sell for. But then all of a sudden, by the time, let's say the trial is delayed and they can't settle the case, the trial comes up 8 or 9 months later. How often do you maybe reevaluate your calculations, and how does that play a role potentially in maybe shifting the percentages of which one you weight the most, I guess? So how does that work?
Yeah, I mean, we absolutely have to update the valuation, you know, especially if it's been 8 or 9 months, because most businesses, you know, should be able to produce accounting records, may need some cleanup, and that's part of a challenge in doing that, an update. A lot of times it can be straightforward and simple and not very time consuming or costly, and then sometimes that's not the case. But we would absolutely want to look at the current financials to see what's gone on since we last valued the business, because we do live in a dynamic world and things change frequently. And we try our best to anticipate those changes or consider those, you know, those risks. There's a lot of, and we'll talk about that in the income approach, but.
And just like the value of Coca-Cola and Home Depot change on a daily basis, the value of a privately held company changes all the time also.
Sure.
Definitely. All right, income approach.
All right, the income approach is more complex than the other two approaches to some degree in certain ways. The bottom line of it is really, I like to say, it's if an investor bought this business, now I'm not talking about intrinsic value like Marty was talking about earlier, but if somebody else came in to buy this business that we're valuing, they really want to know how much cash flow, after tax cash flow, am I going to get, right? If you bought a coin operated laundromat up the street, that's really what you're looking for. You're not concerned about a lot of other things. You want to know how much cash flow is this after tax, I should say, after tax cash flow is this going to generate? And then we divide that by a capitalization rate or a cap rate. That's really a risk rate. How much cash am I going to get, and how risky is this business that I'm buying? A coin operated laundromat, probably not as risky because people are going to need those for a long time. You can look at the historical and see the trend. The revenue should be pretty strict, but it should be pretty flat or increasing at a steady rate. The same thing with the expenses. But then if you're looking at other types of business, there can be a lot of fluctuation in their revenues from year to year, or seasonality, and that can create a higher risk rate. So in terms of when do we use this approach? We use this approach for most closely held businesses. Again, not so much for businesses that have hard assets that can be valued. Again, real estate, construction, manufacturing. But most businesses are purchased, they're service businesses, they've got clients, they've got customers. And if you're buying that business, you're buying those repeat customers is typically what we're looking at here. So this is usually an approach that we put a lot of weight on. The benefits are, especially compared to the other two approaches, one, again, the income approach is more indicative of value of a service or an operating business than the asset approach. And the benefits of the income approach versus the market approach is we're really drilling down on the subject company, and we're not comparing it to other companies that we do in the market approach, where we're not really sure if those companies are true comparables. Again, dental practice is a little bit easier, but a lot of other businesses that we look at, it's difficult to say, does this business operate exactly like these 5 or 6 comparables that we have? The income approach, we're really drilling down, because this is what somebody's going to do if they're buying a business. They're going to say, hey, Mr. Seller, let me see the tax returns, let me see the financial statements, let me see how much money this business is really making, and then I'll make you an offer. So those are, that's when this is used, and those are really the benefits of the approaches that we've drilled down on that. Challenges with the income approach, as you can imagine, for closely held businesses, are the accounting records and the financial records. How accurate are they? Do they have a third-party person doing their tax returns? The challenge of tax returns versus internal financial statements, kind of cleaning up the financial documents to get them to a point where we can really ascertain what is that after-tax cash flow. That's really a challenge sometimes, is getting those records in a format we like. QuickBooks is certainly a great thing, and it's come around. It's a mom and pop accounting software that a lot of people use, of course. It can be a challenge as to if we can get the QuickBooks file or not, and then how things have been coded and how much cleanup we've got to do, cutting out non-operating expenses, and which are also known as personal expenses. A lot of small business owners run personal expenses through their business, and we're not dealing with it from a tax return. We're not concerned about the IRS. We don't deal with the IRS or anything. But if we're looking at what a business is really worth, a buyer's going to want to know how much personal, and the seller would want to tell them, hey, look, I know my tax return says I only made $10,000, but I paid for this, this, and this, and I actually really made $30,000 in profit. And so that's the same sort of thing that we're trying to figure out.
I think that's something that we come across a lot, either whether it's our client that owns the business or the other side. They come in and they say, I'm only making $3,000 a month, and then Lance usually is the one who's picking apart their bank records and says, hey, based on my Excel sheet, it's actually $7,000 or $8,000 a month if you put back in all of these expenses. And that's a hard thing sometimes to explain when the funds are so commingled between a closely held business a lot of the time. So how do you kind of separate those, or what's the best way to organize those, either if we're representing the business or the other party, to assist in really figuring out what the income is?
One of the things we look at is we have these industry analysis from, and they tell us what expense ratio should be for certain accounts. And we compare them with the subject company, and we see if they're very different from what is the average in the industry. And then we try to drill, if we can get the QuickBooks, we drill down on certain accounts that we know there's going to be personal expenses, such as cell phone, automobile, gas, travel, things of that nature. Hopefully we capture as much of the personal expenses as possible. Almost in every case, it's rare if the financial statements have been audited by an independent CPA. So usually they're compiled financial statements, which the person who prepares a tax return just takes the numbers, throws them into a tax return and files it. And so they're not looking down and drilling down to see what kind of personal expenses are going through. So we try to capture as much as possible in our analysis.
And very frequently, especially if we're going to court, initially, if we're doing a business valuation to go to a mediation and try and do that, again, Marty mentioned the expense ratio, so we'll make some assumptions. Now, if mediation doesn't work or we can't get the case resolved and we've got to go to court, then we're going to have to spend some more time and expense to drill down on those operating expenses so that when Marty and I get up on stand, we can say, no, look, we looked at the bank statements, we looked at the business credit cards, we saw expenses going to Staples, we saw expenses for car tires, those kinds of things, and we have to make some professional judgment. We do like to do a management interview with the business owner, certainly, and we've done lots of those, so we know how to approach the business owner, whether they're our client or whether they're on the other side, and ask the right questions to try and suss out some of those non-operating expenses. Frequently, the outspouse, the spouse that doesn't own the business, may work in a business, or spouses talk about their business a lot, so they'll know. And on the personal side, we'll ask you guys. We may be assisting with the marital balance sheet, but if we don't see any car payments coming out of the personal credit cards, we don't see the mortgage payment, we don't see utility payments coming out of the personal side, well, then they're probably coming out of the business side, and we need to make sure we account for those. So it's kind of what's missing or what is there.
Well, so for Jenni and I think one of the dead giveaways, and it's probably happens more often than not, is the client or the opposing party will only have one account. There's not a separate business account, which is a dead giveaway when they go, what do you mean it's personal? That's usually a dead giveaway. But in y'all's experience, how often do you see the mixture of personal and business when you're doing these evaluations of a mom and pop or a very closely held business?
We frequently see, I would say it's less rare that we see where they just have one bank account, a personal bank account, and they operate their business out of there. That business, those kinds of businesses are usually pretty small and they're reported on Schedule C, and there's typically not a lot of value. But we do see where folks establish a business bank account and business credit cards. In almost every case, there, especially for closely held businesses, there are some personal or non-operating expenses in the business. Again, cell phone, you pay $100, $200 a month, or maybe $300 a month for your family cell phone plan, and you let the business pay for it. Well, yeah, we know you use your cell phone for business, but not 100% of the time, maybe 10% or 20%. Same, automobile is a big one. Meals and entertainment, that kind of stuff. Utilities not as much, but we have seen that on occasion. So it's pretty frequent. That I would say it's almost unexpected if we have somebody who's got really clean books and we don't see any personal expenses being run through. That is incredibly rare. One other thing I do want to mention is, Marty, why don't you talk about cash revenues, that are a part of this? Because a lot of times we start with the tax returns and the financial statements, but cash revenues are a big part of this.
Especially if the client is in a type of business where they accept cash for the sale of their product or services. And typically what we're going to do there is we're going to look at the ratios that the industry report says. So for example, let's say we're talking about a landscaping business, and we know that the landscaper has been pulling in cash. And we say, well, how do we figure out how much? Because he's probably, if he's on the other side, he's not going to tell us the exact amount. And so in our industry reports, we say that, so typically if you have $1,000 of sales, it's going to, the material might cost you that you have to put in for landscaping might be $400. So that would be a 40% ratio. So now if we see that the subject company has a ratio much higher cost, where the cost of its product is 60% of sales, then we can see the shortfall and say, well, this must be some cash that he's not reporting. And then we'll hit him with that, and hopefully he'll open up and come straight with us.
Right. And again, we'll look at the business bank statements to see how much cash is being deposited into the bank account that may be bypassing, the financial statements that get turned in for the tax returns. And then sometimes people just keep a big, roll of cash these days. Everything's going digital and Apple cards and Pay and Apple Pay and everything. But, the out spouse will give us some information related to that. Oh, he always pays for this in cash. We do this, we've got cash in the bank. So, or in a safe at home.
How much is your role when you're doing these evaluations? How much, if at all, is your role to try to ascertain and find the revenue or income that may be off the books? How much do y'all do that? And again, kind of just explain that. I think you did a little bit, but
yeah, it's a big part. I mean, and I'll say this. Marty and I and a lot of business valuation experts out there, regardless of whether we're working for the business owning spouse or the out spouse, again, the spouse that doesn't, our valuation is really going to be the same. And we're not, we were hired by one side. Sometimes we're hired as a neutral and work for both parties. But regardless of that, we want to make sure that we're coming up with an accurate value. And the cash, the unreported cash revenue is a part of that. We want to make sure we've got a good value so that the party understands what the value of that asset is, because the other side is going to certainly have an expert. And if you go to trial and you're not being honest with what the value is or what the revenues are, the judge may penalize you for that. And so in terms of awarding more value to your business than you thought. So we want to make sure we've got an accurate value. It helps get the case settled. It helps the parties realize that we're not going to play games. And it doesn't mean there aren't differences of opinion of value depending on who we're working for. And that's because of the information that we have. If we're working for the out spouse and we don't have all the information related to cash, or realize that maybe somebody's paying cash expenses associated with that cash revenue, then there can be little tweaks and changes there. But the cash flows are a frequent part of things. And we know the industries that typically have it. Marty mentioned landscaping, restaurants, they're becoming less and less frequent for restaurants and some other industries to some degree, but we know that they're in there, and we're always going to ask, especially if we're working for the business owner, we're going to say, look, we know there's cash flows, there's unreported cash revenue. How much is it? Let's kind of get that on there. Let's make sure we disclose it so we've all got credibility with the other side and with the judge when we get there.
Yeah, I think some industries, it's very clear that they accept cash. I mean, if you walk into a hair salon or a nail salon, there's very frequent times a sign right at the front desk, right, that says, if you are paying cash, you're getting a discount, or we prefer you pay cash. So I think that that's an important fact, is just paying close attention to the industry that you're looking at and being aware of what's typical within that industry.
Exactly. And something along the personal expenses, as a general rule, but not in every case, but as a general rule, if there are multiple owners of a business, there's probably less personal expenses flowing through the company than if there's one owner.
Right. That's a great point.
Me.
Yes, right.
Right. And if you've got even more, if you've got 4 or 5 owners, especially unrelated owners, it's less likely that I'm going to let Lance, I'd bring up a lot of grief to Lance if he's paying his personal car through the business, unless all of us are getting to pay our car through the business. And then that just becomes complex. So that's why the more owners you have, the less likely you have non-operating expenses or personal expenses paid. Great point, Marty.
Yeah. And that actually brings up a question that I had is, y'all are able to do these valuations, whether it is a husband or a wife that owns the business, or if it's they own a portion of a business with 3, 4, or 5 other people.
Yes.
Yep. Yeah. They don't have to be 100% owner, and there are some discounts. We won't get into that today, but there are some discounts that you would take if you're only a 30% owner, if you're a minority owner of the business. Somebody who came in to buy your 30% share is not going to, they're like, well, I don't get to control everything. I'm not going to pay quite as much as if, but no, we absolutely look at, can value any business using these approaches according to the Certified Valuation Association and AICPA. These are very common approaches for that.
Before we get into the goodwill, the next subject, that's actually, I think, a really good topic. We can just segue just for a second is, so y'all can value a business. So we have, again, parties going through a divorce, but they have especially outside owners or partners, and they're only a third owner. But at that point, y'all still would go through the same process and still can put a value of that marital component. When you do that, is it more difficult? Do you receive pushback of privacy, confidentiality from those other two owners, maybe in my hypothetical? And how do you get around those obstacles?
Yeah, I mean, we do have that happen on occasion. You know, a lot of times we'll sign a confidentiality order. You know,
Right.
the attorneys, both sides will sign one of those. You know, and we are very conscious of the fact if we're working for the out spouse and the business owning spouse owns 20%, you know, we're not wanting to put any more stress on the parties or the business than possible. We don't want to kill the golden goose, right? So we're very selective in the information that we ask for, but we do have to be thorough in what we ask for. So sometimes that can be there, and a great way is a confidentiality agreement that you guys would draft, the attorneys would draft and ask us to sign.
And it's professional suicide if we start revealing information. And so we're very conscious of that, not to do that.
Yeah.
Right. And I think that you had a really good point of your goal, and obviously our goal as the attorney, is not to do anything, no matter what side you're on, that hurts the business. Because at the end of the day, that's an asset for both parties, the owner and the spouse. And if you're hurting the business, you're hurting both clients.
Everybody
Exactly.
loses.
Frequently, that's going to be the source of alimony or child support or whatever else.
But sometimes we have clients who have irrational thoughts who say, I want to see him die. So,
Ouch. Ouch.
and
Right.
with his business. Okay. But
Yeah, and we'll
That's
be
a
a part of that
different-
conversation with you guys.
how do you deal with the client who wants the business to go belly up?
Well, I mean, like you
It's
said,
gonna hurt her.
we talk with them that, you know, look, this is what's going to pay the child support that you hope to receive, or pay the alimony or everything. You know, you want that business to be doing well. You don't want it to do poorly. You want it. That's how you're going to get money too. So
Exactly. This is probably my favorite part of the business, is the personal goodwill. But before we dive too deep into that, can you just give us a overall, what is the difference between personal goodwill and enterprise goodwill?
Sure. So goodwill in general is really what would somebody pay for a business above the indicators from cash flow or the market approach or anything like that. And so you've got two kinds, enterprise and personal. Enterprise goodwill is goodwill that's associated with the business. So, you know, State Farm, the name State Farm, nobody's buying business because of the people. They're to some degree buying because the people at State Farm, but not the actual people. They're buying it because State Farm has a name. And personal goodwill is more where somebody, you know, the clients come to the business for the person running the business, or they're, you know, they're interacting in terms of sales. They're not coming to the business because it's, you know, 1, 2, 3 automotive repair. They know, oh, it's Joe, my mechanic, who owns and operates this business. I trust Joe. You know, that's really the difference between the two. Personal goodwill, we hear that a lot.
Example, Luke, go ahead and use us as an example as a law firm.
Right, yeah, law firms exactly are a great example of personal goodwill. We don't see a lot of transactions, especially for family law firms. People aren't buying and selling family law firms. You guys are the law firm when it comes to, you are the business. You know, people come to see Lance and Jenni. They're not coming to, you know, to the name of the firm. You know, in any case, big firms, small firms, any size law firm. Now, dental practices, and a good indicator of personal goodwill is closeness of contact. You guys have closeness of contact, maybe not physical closeness of contact, but emotional and you know, getting to know someone in terms of all of their details, their financial details, just like we do. Now, a dental practice, a dentist has closeness of contact physically, right? They've got their hands in your mouth, and that's typically a good indicator of personal goodwill. But we know that dentists sell their practices all the time. And we all care about having a good dentist, but we realize that there are lots of them out there and we can go from one to the other. So that's why, you know, we're okay with having a different person have their hands in our mouth the next time. Certainly gloved up and masks and everything at this point.
Yeah, and I think this is really interesting because this is something that we come across a lot, right? So the business owner says, well, the business is worth nothing. I am the business. And sometimes that is true. And then sometimes you dig in deeper and you find out that, yes, you initially got the customer, but you haven't had direct contact with that customer in a year because it's, if it's a landscape company and you have other people, you're not mowing their yard, right? You're sending someone else to mow their yard and they're happy so long as their yard is getting mowed. Or, there's all different kind of examples, but how do you overcome that of explaining to someone that, yes, you got the client initially, but you are not the business yourself?
Can it be transitioned to another party? And also, if it's a product versus a personal service, it's a tremendous difference because typically people are looking for a product. It doesn't have to be the same person delivering the product. They're really not buying it. We had a case, opposing side was saying that the sale of a soap pad for a washing machine, and most of their customers were Dollar Store and Family Dollar, and they were saying, well, this guy's got the relationships. Well, the major thing they're concerned with is cost. They could care less if they've got the same representative delivering that product. They're really more interested in the cost. A lot of times this personal goodwill, our understanding from a legal aspect is that it's off the table if you can establish personal goodwill, pure personal goodwill. It's off the table for negotiations in a divorce setting. And so what we're going to look for is a unique talent. And my favorite example is a neurosurgeon or a heart doctor for infants. That's a talent that really can't be transferred to another physician. That's very unique. That would be pure personal goodwill. As opposed to a CPA practice. Yeah, the CPA's got a lot of relationships, but the party's really interested in getting their tax returns done on time, paying the least legal amount of taxes. And so that can be transitioned to another party. And one of the indicators, if it can be transitioned, if there's a lot of data in the market databases, if there's a lot of transactions, then obviously this has been transitioned. Luke said dental practices, if you go into the databases, they sell all the time. So the dentist has a lot of personal goodwill, but it's transferable personal goodwill because they sell all the time.
One thing I like to...
That comes back to what you said, Luke, about a willing seller and a willing buyer. So if it was a person who was willing to sell their business, there would be a transition time and they would be participating in that for the most valuable amount for their business.
Absolutely. One question I like to ask or have the attorneys ask, especially, if it goes to court and somebody gets up on stand is, so what do you plan on doing when you retire? If this business is truly personal goodwill, then you're just going to have to lock the doors, turn the lights off and walk away and you'll never get a dime. That's not typically what most folks are going to do. They're going to try and find a buyer. They're going to try and bring on somebody younger and transition whatever skills they have if they can.
Yes, just I guess for people listening too, the reason why it's important is, one is subject to marital division and one's not. And so obviously we always get the argument because we're trying to argue that it's all personal, so it's not part of the value. And that's why it's important to have this distinction. And I think it's probably one of the biggest things we get from our clients who are asking, because they'll get a value back from Luke and it's worth X amount. And they're like, no, I'm the business. When I'm done, it's worth nothing. It should be worth nothing. And we get that argument. I'm sure every attorney out there who does family law has heard the same argument. And again, that's where y'all breaking it down, not only on the income, asset, and market approach, but then I think y'all break it down on goodwill and how you added it and factored it back in. It helps us as attorneys also explain to our clients of where this number came from. And so I think y'all provide an invaluable service when it comes to putting a value on an asset that we have to. And it's very difficult sometimes. So,
and
absolutely.
There's case law in other jurisdictions where they talk about attribute, personal goodwill attributes and enterprise goodwill attributes. And we would go through that questionnaire with the client or the opposing party and find out. One of the big things on the enterprise goodwill is their recurring revenue, like a CPA practice. If they do a lot of tax returns, typically customers come back, clients come back every year to get their returns done, as opposed to family lawyers. For the most part, you might have modification of alimony, modification of child support, but for the most part, once you're finished with a client's divorce, you have to go find the next client.
Right. Unless you've got Liz Taylor for a client, and you might have 6 or 7.
We've got a few of those returners, but the general rule is, you're right. They come in and, you hope for both sakes that you don't have to represent them again.
Right.
In a case, and sometimes, unfortunately, that's not the case, but that is the general rule for us. Here's just some, we're almost out of time, but I did want to go through these questions if we have a few more minutes. How do you account for a successful business with very few customers? If you have a business that generates, let's just say $200,000 a year, but they only have 2 or 3 customers. If they lose one of those customers, that's going to drastically affect their revenue. How do you account for that?
Right. So that, there are a few different ways to account for it, but one big way is in that cap rate that I mentioned for the income approach. We're going to increase that risk rate for this company. It's not, if they had 100 customers and they lost one that only accounted for 10% of their sales, that's not a big deal, because businesses are frequently losing customers or clients, but they're gaining customers and clients. If you've only got 2 or 3, your risk rate of the business, instead of being around 20% or so, if that's where it's, typically, we may be at 30 or 33% to help account for that. That's something, again, we're always thinking about this from the perspective of the seller and the buyer. Seller's trying to get as much money as possible. The buyer's trying to pay as little as possible. And if I'm buying this business, yeah, that's great revenue and great profit that they're making, but you only got a couple customers and I'm a little nervous. And also personal goodwill can come in to fit in here a little bit. There may be a small carve out for personal goodwill that can be considered.
How about the next question, that this is a little bit of tracing in regards to a business that was started prior to the marriage. So we'll use an example of 2000. Parties get married in 2005, and now all of a sudden they're getting divorced in 2020. How does that play a factor, and how are you able to maybe ascertain the premarital portion versus the marital portion that will be subject to equitable division?
We work with various attorneys like yourself, including yourself. And so we would have to do 2 valuations here. One valuation as of the date of marriage and a current valuation. And what we would then look at is if the value of the business increased during that time of the marriage, the question then becomes, did it increase for passive reasons, such as if you had ownership in Coca-Cola stock and you don't work at Coca-Cola, so you didn't have anything to do with the increase in value of Coca-Cola stock, that would be passive, and that would typically be off the table for negotiations, as opposed to if it was active participation by the parties. If they increased the value of the entity, then our understanding of the law is that it's subject to equitable division.
How about in regard, I guess, to the difficulty of going back and finding financials from 15 years ago? What if you're unable to maybe get those documents? And I know we've had this issue before where we try to even subpoena a bank directly and they indicate that the statement no longer exists or they don't have access to it. So there's been those times when you have a very lengthy marriage. What do you do at that point, Luke, if y'all are hired to do an evaluation and you start digging into it and you realize you don't have a lot of data to go by? What do you do at that point?
Well, that's a big challenge, and we do see that frequently. Fortunately, a lot of the cases we've been able, the party was able to get tax returns from maybe not the IRS or bank statements from the bank, but maybe their CPA. If we don't have any sort of financial statements, that's a big hurdle. We will try and come up with other ways. Do you have any sort of reports that showed what gross revenues were? What were sales for the company back then? And then we'll kind of compare that to the metrics today and try to come up with something. You know, the court challenges us to use the best evidence possible, and you know, other reports or even testimony from the parties, you know, could be considered. You know, the court may not put a lot of weight on our valuation as of the date of marriage if we don't have a lot, but they may give it some weight. So, you know, especially if it seems reasonable. If the company says, oh, you know, my sales were 1/10 of what they were, there better be some good reasons for why the growth's happened. Or if sales are pretty comparable, you know, again, we're going to try and use the best information possible.
Do you always, when you're evaluating a business and really trying to look at, okay, what is this business worth? Do you always consider all three approaches in looking at that business?
Yes, because our standards say we must. Now, we might not put weight on one or two of the approaches ultimately because we don't think it's applicable in a specific valuation, but we're required to look at all three approaches. If we don't, we could get kicked out of court.
Yeah,
Well,
and I'll say that
we had a case together where that happened, where y'all considered all three, but ultimately I think gave 100% weight on one approach because the other two were not applicable in that case. So that was a great example that we just went through ourselves on the case together.
Yes.
right. And I'll say it's very rare. It's not uncommon to have weight on two approaches or weight on one approach. It's pretty rare to have weight on three approaches. I say that because you're either going to have weight on the asset approach and you're not going to have weight on the income and market approach, or you may have weight on the income approach and you don't have good market data and the asset approach isn't relevant because, again, we're looking at an operating entity. Or you may have, weight on market and income, but we don't typically have weight across all three. And I heard somebody use an analogy years ago. It's a great mental analogy, mental picture to say, oh, business valuation is like, you know, a stool. All three of the legs need to be equal, and that makes a very sturdy stool. And that's really not the case, or sturdy chair. You know, we don't want that. That's not what you. No, it's not that we don't want it. It's not that we just don't see that frequently. A lot of times, especially for an operating business, the income approach is the most indicative of value, and the asset approach is that liquidation value. They're not going to be the same. They're going to be pretty different. So,
Yeah, it seems
the
like
amount of weight we put on the market approach is dependent often on how much good data we find. So if we find very few transactions, we might not put any weight on the market approach. On the other hand, if we're doing a restaurant or a dental practice and there's 30, 40, 50 transactions, and if the transactions are all consistent from all three databases, then that gives us a lot more confidence that there's credibility on the market approach, and we would give more weight to the market approach accordingly.
When was that database created, I guess? So how far back are y'all able to look, again, in a lengthy marriage, how far back can y'all go back to look to compare sales from that database? One
of them, for school, we pulled up, one of the groups is going to do a restaurant, and we pulled up data. It was in the mid-90s.
Oh, wow.
They had transactions going way back there. Now, typically, we're not going to use that because things have changed so much in the last 24 years. So it's probably not going to wait. Heck, things have changed a lot this week, if you want to be realistic.
but if we're doing a date of marriage valuation or date of gift valuation, you know, somebody gifted the business, we will look back as far as possible. But there's fewer transactions reported. These databases existed before the internet. They were just in paper books back then.
Yeah, but that's right. That might be very helpful if you're trying to determine a value of a company that you don't have any information for, you know, that started in 2000. They don't have anything that's 20 years old. That might be the place to go. So what is the best way for someone to reach out to you, whether it's someone who is going through litigation and they want to know the value of their business, or if it's someone who's just considering selling their company and they want to figure out what is my value worth?
Sure. You can email us or call us, but I would say, especially if you're in litigation, we'd like to get on the phone and talk with you and your attorney. We don't work, if a client's in litigation, we don't work with them unless we're working with their attorney. And the reason we do that is to have attorney work product privilege, protect everything so that we're acting as a consultant early on, you know, and down the road, if we become a testifying expert, we may have to disclose, you know, our work product and how we got to where we did. But, you know, we offer free consultations, you know, sit down with people and figure out, is this an opportunity where we can add value to your case? Is this a business? Lance, we've had a case recently where we looked at it. It wasn't really a business as much as it was sort of a side gig that somebody had. And that doesn't mean that there's no value to the business. That may have been the case, but then that income's there for alimony and child support purposes. So, you know, like I said, we do free consultations because we want to figure out if we can help add value to your case. Or if somebody's just looking to potentially, we've had cases where people wanted, or engagements where people wanted to know how much your company was worth so they could start selling it to employees and let them buy it over time. You know, we do that kind of stuff as well. And like I said, we just sit down with folks and talk with them as, what are your goals? How do you want to do this? You know, what kind of timeline are you looking at?
And again, just to summarize that, so for your company, IAG, do y'all do other things outside of family law and divorces? And if so, just make sure you clarify that. I think y'all provide other services as well, that not only maybe y'all specialize in, but you have a number of other employees at the firm as well that also assist. Yeah,
absolutely. We're primarily litigation focused. We do some business valuation work for non-litigation purposes, for goodwill impairment testing and those kinds of things, you know, buy side, ESOPs, employee stock option plans, but we're primarily litigation focused. So any sort of financial matter that involves litigation, business disputes, business divorces, and then, you know, family law divorces.
We're doing valuations of a business that was been taken over by the this county or the state, eminent domain.
Yeah.
Sure.
And all of a sudden they had to shut down the business, so they need a valuation on the business. And then of course they have to hire a real estate appraiser to value the amount of the real estate.
So essentially it's just not family law, but anytime a business is involved in litigation and someone needs a value on it, y'all are there to provide that service.
Absolutely.
We have fraud investigations.
Great.
We've had cases where the lunch lady was taking money from the school, pocketing some of the money, and we've done investigations to, you know, find out how much was taken.
Yep.
Yeah, it's very, very interesting. Well, Marty, Luke, thank you so much for your time today. I really appreciate it. I think that y'all provided a lot of clarity. These are questions that we're asked all the time, and we really appreciate your time today.
Oh, thank you.
Thank you for having us.
Opportunity.
Yeah, no problem. Well, thank you again for providing such great information, not only to us, but everyone else who's able to watch this. Thank you again.
Thank you.
Thank you.